Hello everyone, this is Roger Scott. I hope everyone had a great vacation. I'd like to wish everyone a happy, healthy New Year's. Today, I'm going to teach you one of my favorite pullback strategies. Before we begin, I have to go through the required government disclaimers. So please keep in mind that this video is not intended to be a trading recommendation. There is a substantial risk of loss when trading futures and options on futures. Please use risk capital and read the required disclaimers carefully before we move on. The strategy is called the 4x4 pullback strategy. I've used this strategy for over 12 years and still find it very useful for trading both stocks and futures. The strategy works both intraday for day traders and for short-term swing traders who prefer to hold positions for a few days or a week at a time. I prefer to use the 4x4 pullback strategy on high-volume stocks and index futures contracts, both to the upside and to the downside. The basic concept behind the 4x4 pullback strategy is to identify a strong market trend followed by a retracement or a pullback in price for a short period of time. Once the market backs away and pauses, it typically resumes and continues moving in the direction of the main trend after a short and temporary retracement in price. Our job is to identify this temporary pause and jump on the wagon or get into the market during this temporary pause before the trend resumes and leaves us in the dust. The first part is to identify the trend. Since the 4x4 pullback strategy is a retracement strategy, the first and the most important part is to figure out a way to find a market moving strongly either up or down. There are many different ways to locate a strong trend. This particular strategy does not use any technical indicators and relies simply on price action. For many trading methods, price action is the simplest and most accurate way to determine and identify market action. The 4-week or 20-day trading day price high or low is a good way to identify markets that are trending in one direction or another. It's a rather simple way to determine a trend, but it tends to work well with stocks and stock index retracement strategies. The first thing is to find our stock, or if you're trading E-minis, the futures contract, and make sure that the last trading day's high is the highest price during the last 4 weeks or 20 trading days. Here, you could see a good example of the Chicago Mercantile Exchange stock making a 4-week high. The stock is not overly extended, but is still trending strongly in one direction. If you're comfortable shorting stocks or selling E-minis, then you could also monitor stocks and futures that are making 4-week lows. You could see here Luminex stock making a 4-week low. The market is not overly extended, but is clearly trending down with a good slope. Anything over 20% is a good slope for stocks and futures as a general rule. The second part is to identify the pullback. This is very important because this will create the entry opportunity before the stock or the futures contract once again resumes the trend. For this second part, we will also rely on price action and avoid any technical indicators. What you'd like to see is a price closing lower 3 consecutive days in a row after the stock or the futures contract makes the 4-week high. If you're trading to the downside, you'd want to see a stock or a futures contract to close higher than each previous day for 3 consecutive days, starting immediately after the market makes a 4-week low or a 20-day low. I use 4-week low and 20-day low interchangeably. The next part to the 4x4 strategy is finding the proper entry point as close to the turning point where the market is beginning to resume the main trend. This way you can maximize your profit potential and reduce your risk level substantially. Always remember, the lowest risk trades are where the main trend and the minor trend intersect. The crucial step is the 4th day, the day following 3 consecutive lower lows if you're trading to the long, or 3 consecutive higher highs if you're trading to the downside. On the 4th day, the market must close above the high that was reached on the 3rd and last down day. If you're trading to the downside, the market must close lower than the low reached on the 3rd up day. The next day, the 5th day, is the entry day. If you're trading stocks, put a buy stop 5 cents above the high reached on the 4th and the last trading day prior to the entry day, and put a stop loss 5 cents below the low that was reached the same trading day. If you're trading E-minis, you would use 2 ticks above the 4th day high to enter and put your stop loss 2 ticks below the low reached on the 4th day. If you're trading to the short side, you would reverse the rules by selling stocks 5 cents below the low reached on day 4 and enter a protective stop loss 5 cents above the high reached on day 4, the day prior to the entry. If you're trading futures, just substitute the 5 cents for 2 ticks and that should do the job. A good way to calculate profit targets using the 4x4 method is to multiply the distance between your entry and your stop level by 3 and add it to your entry if you're trading to the long side. If you're trading to the short side instead, simply multiply the distance between your entry and your stop loss by 3 and subtract it from your entry price. I realize all of this might have been a bit confusing, so I'm going to give you the rules to the 4x4 trading strategy again so that you have a clear idea of what your next step or your setup should look like. To go long, wait for the market to make a 4-week high. That's a 20-day high. The next 3 trading days should have 3 consecutive lower closing prices. The next day, the 4th day, the market should close above the high of the previous day, the 3rd day, the last down day. The next day, enter long above the high of the 4th day, the first up day, and place a stop loss below the low of that day. Calculate your profit as the distance between your market entry and your stop loss multiply by 3 and add it to your entry price. Short entry is reversed. Therefore, you wait for the stock or futures contract to make a 4-week low and rally 3 days in a row, closing higher each day. The 4th day, the market must close below the low that was made the previous day, the 3rd day. If conditions are met, place a sell stop to enter short below the low made on the 4th day. the previous day and place a buy stop to protect against unexpected rallies. Don't forget to calculate your profit target as the difference between your entry and your buy stop and subtract this from your entry. If you want to see more setups similar to this one, visit us at MarketGeeks.com. We update these setups several times each week on our blog at MarketGeeks.com/blog. This is Roger Scott wishing you all the best for the coming year from all of us at Market Geeks.